What's going on, guys? It's your boy Tyler, bringing you fundamental news on the 7th of May. Today's article is brought to you by Dow Jones Newswire. Buy treasuries, sell gold and other ideas for a Fed pause. It might finally be over. The Federal Reserve raised rates by a quarter point on Wednesday, delivering what could be the last increase in the biggest rate hike cycle in a generation. Investors may now want to position for a pause or even a potential reversal. The Chicago Mercantile Exchange Fed Watch tool, which gauges the market expectations via the pricing of federal funds futures, implies a 4% chance the central bank will raise rates again in June and a 96% chance the Fed pauses. Guys, when they put it like that, it's technically guaranteed the Fed is gonna pause. There's a 96% chance they're gonna pause and a 4% chance they're gonna raise rates. So in my opinion, it's technically guaranteed we're having a pause. Markets are already pricing in a greater than 50% chance the Fed cuts rates by the end of September. Investors have grappled with an environment of rising interest rates, the Fed's bid to control decades-high inflation for more than a year. Tightening financial conditions have notably hit high-growth stocks. Tightening financial conditions basically means raising interest rates have notably hit high-growth stocks such as your FANG stocks, your tech stocks, especially those in tech sector. Just like I said, if a sea change is coming, investors best be prepared. Luckily, Bank of America has some ideas, and Barron's has some suggestions on exchange-traded funds, aka ETFs, to capitalize on them. The Bank of America list comes from its previous examination of asset returns in the 3 months after 10 last hikes of the past 50 years. The 5 suggestions were revisited in a Thursday note from a team of analysts led by Michael Hartnett. The first idea is to buy treasuries, which return positive 9 out of 10 times after the last increase. According to a Bank of America analysis, treasuries have averaged returns of 7% after the last Fed hike in inflationary cycles. We agree, long treasuries, said Hartnett's team. Investors wishing to follow suit can look to ETFs such as the iShares 20-plus year Treasury Bond ETF. It is a different matter for corporate credit. While investment-grade bond returns have been positive 9 out of 10 times after the last Fed hike in inflation cycles, averaging 6% returns after 3 months, Hartnett's team sees risks amid a gloomy macroeconomic background. While investors have been attracted to the likes of iShares, iBox, investment-grade corporate bonds, this time around it might be worth steering clear. The US dollar is a safer bet. The greenback has grown stronger 7 out of 10 times when the Fed finishes dealing with inflationary cycles, according to a Bank of America, with returns averaging 5% after the last Fed hike. While Hartnett's team said they are big circular sellers of US dollars, a surprise rally in the currency would make sense in the risk of move they see coming. The narrative could be shifting for another asset viewed as that's viewed. Where the fuck was I? The US dollar is a safer bet. The greenback has grown stronger 7 out of 10 times when the Fed finishes dealing with inflationary cycles. According to Bank of America, with returns averaging 5% after the last Fed hike, while Hartnett's team said they are big circular sellers of US dollars, a surprise rally in the currency would make sense in the risk of move they see coming. The narrative could be shifting for another asset viewed as a safe haven, gold. The precious metal flirted with record highs this week, with continuous contract futures firmly above $2,000 an ounce on Friday. However, gold has returned a negative 7 out of 10 times after the Fed's last inflationary cycle rate increase, losing 13% on average. While Hotnet's team said they love gold long term, it stands to reason gold could fall back below 2000 if the dollar has a risk of slide. It may be a similar picture for the stock market at large. While the rise in interest rates wreaked havoc on the S&P 500, which shed nearly 20% to see its worst year since 2008, an end to rate hikes may not mean an immediate bounce for the index, up 7.3% since the start of January. Stocks returned negative 50% of the time after Fed's last increase in any given cycle, but they have done so out of five times when that cycle has been inflationary, like the current one, with average losses of 3% after the last hike. Hotnet's team believe a breakout from the S&P 500's current 3,800 to 4,200 trading range is more likely to the downside. Investors wishing to capitalize on the bearish mood could do so with the direction daily S&P 500 bear one shares. Of course, the timelessness of all this advice depends on what the Fed does in June or even July, when the markets are still pressing in a slim 2% chance of another 8% rate hike. But a pause is coming at some point. There you have it, guys. They say a pause is coming at some point. Again, thank you for listening, and don't forget to like and subscribe.